What are they, really, and why should you care? Stick around, because by the end of this video, you'll have a solid understanding of how it all works. So, let's start with the basics. Imagine you have a brilliant idea for a new company, but you need money to get it started. On the other hand, someone else has saved up some cash and wants to grow it, but they don't have a business idea of their own. A financial market is like a giant, organized meeting place where these two people can find each other. It's where those who need capital, like our entrepreneur, can connect with those who have capital to invest. Essentially, financial markets facilitate the flow of money from savers and investors to borrowers and businesses. This process is called capital allocation, and it's super important when capital flows to the most promising ideas and companies. It fuels innovation, creates jobs, and helps the economy grow. Think of it as the circulatory system of the economy, pumping money where it's needed most. Now, there isn't just one single financial market. There are many different types, each with its own purpose. The two big categories you'll hear about most are the stock market and the bond market. The stock market is where you can buy and sell shares or stocks of publicly traded companies. When you buy a stock, you're buying a tiny piece of ownership in that company. If the company does well, the value of your stock can go up. This is a way for companies to raise money by selling off slices of ownership, and for investors to share in the potential profits. Then you have the bond market. When you buy a bond, you're not buying ownership. Instead, you're essentially lending money to a government or a corporation. In return, they promise to pay you back the full amount, called the principal, on a specific date in the future. Along the way, they also pay you regular interest payments. Bonds are generally considered less risky than stocks, offering a more predictable stream of income. So, you have stocks for ownership and growth potential, and bonds for lending and steady income. Together, they offer different options for people and institutions to manage their money based on their goals and how much risk they're comfortable with. But who makes all this happen? A bunch of key players are involved. You have the issuers, which are the companies and governments that need to raise money. Then you have the investors, which could be individuals like you and me, or large institutions like pension funds, insurance companies, and mutual funds. And connecting these two groups are the intermediaries. These include investment banks that help companies issue stocks and bonds, and stock exchanges, like the New York Stock Exchange, which provide the platform where all the buying and selling actually takes place. Regulators, like the Securities and Exchange Commission, or SEC in the US, also play a crucial role by setting the rules to ensure the markets are fair and transparent for everyone. So, why does any of this matter to you? Well, financial markets impact your life in more ways than you might think. The interest rate on your car loan or mortgage is influenced by what happens in the bond market. Your retirement savings, if they're in a 401k or a similar plan, are likely invested in the stock and bond markets. The health of these markets can directly affect the overall health of the economy, influencing job security and the prices of goods and services. Understanding the foundations of financial markets isn't just for Wall Street experts. It's about understanding a fundamental part of our world. It empowers you to make smarter decisions with your own money and to better grasp the economic news you hear every day. That's a wrap on our intro to financial markets. I hope this breakdown made things clearer. It's a huge topic, and we've only just scratched the surface. If you found this helpful, hit that like button and subscribe for more content to help you navigate the world of finance. Got questions? Drop them in the comments below. Thanks for watching, and I'll see you in the next video.